Welcome to episode 29 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship in entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lemus. Today's conversation is with Sarkaw Aziz, who was in and out of his first deal in just 2 years. He exited for a great return, but we really get into the decision to sell rather than keep going. Max, what did you think of Sarkaw's story?
Well, I think you summed up the biggest point right there, that he sold after 2 years, he and his partner, and had a nice return. So I know Nicholas is eager to speak more about that, but I've known Sarkaw and his partner Philip for several years. I've been familiar with the deals. So it's in the property management space. They bought a platform basically in Keystone, Colorado, a property management platform that was very large. And he mentions in the episode that it was kind of a learning experience in terms of financing that deal because it was much larger than what they were anticipating going after when they started their venture. They didn't really classify themselves as independent sponsors early on. I think it's kind of debatable as to whether they ended up being that or some variation of that. But at the end of the day, it doesn't really matter. So they bought the nice platform. They did a couple of bolt-ons. Ultimately, it became difficult for them to compete against some of the other capital providers in the space, some of the other roll-ups in the space that they were simply just getting outbid by. So I thought that was, a thoughtful point that he brought up, and it certainly affected their decision to exit the investment rather quickly. They were also early to this space, this property management space, which highlights the importance of finding these deals in these industries that are in the early innings. It's not as easy as it sounds. It requires vision. I think, Sarkaw and Phil obviously had that.
I think for me, exiting in 2 years, so they did well. They got 2x MOIC and 41% IRR for their investors. And investors will take 41% IRR all day long. But I was nonetheless curious about the decision to exit after only 2 years. They had done a couple of add-on, bolt-on acquisitions. Organically, things were going well. And so I was eager to hear the inside of the boardroom conversation around this topic. And I'm concerned I was grilling Sarkaw too much, because at one point he's like, well, maybe it was a failure, which is, of course, ludicrous given the IRR that they actually produced. But it is also true that when we underwrite these deals, most deals that we look at have a 5-year investment horizon. Most deals will project an IRR around 30% or a MOIC of, call it 4 or 5x in their base case projections. And so it seems like here they're tracking well for that, but they kind of cut it halfway in the life cycle. And we also discussed a little bit the tax implications of doing so, because there is a distinction between short-term capital gains and long-term capital gains, both for LP money, but also for carried interest. And so overall, it was just interesting. And we get to learn that the dynamics involves a rolling seller who was very involved, but eager to get that second bite of the apple. It involved investors who weren't able to step up and support continued acquisitive growth. And so it feels like it wasn't necessarily that the offer to exit was too good to be true and it would never reappear, but it was almost like it was a little bit of a defensive move that, okay, this might be a winner takes it all market. We're not that winner because we don't have access to the same kind of capital. And so here's an opportunity to join one of the big groups. Interestingly, Sarkaw calls it a big win for his investors, which it is at 41% IRR. And he calls it a decent win for himself and his partner as the sponsors of the deal. And so with that, we then get into a little bit the terms that they had. And he expresses a desire for his next platform to be a little bit cleaner or simpler in how they structure it. Because I think quite a bit of the upside they would have gotten, quite a bit of the carry would have been based on MOIC, which was 2x here, So where they generated a really good IRR and deserved all the carry that they earned, it could have been much higher if the rest of that kind of waterfall had been based on IRR instead of MOIC. So I think he reflects a little bit on that. Overall, very transparent with the numbers, with the journey, with the ups and downs, with the uncertainty that revolves around every strategic decision. And I thought that level of transparency was cool to hear. Also, this was very fresh. The exit happened a few weeks ago and this summer.
Yeah, I really appreciated Sarkaw sitting for our interrogation and letting us do surgery really on that decision. But it deserves attention because it's an important strategic and philosophical one. I think one other element that we touch on that fed into the decision was this was their first deal, and the opportunity to get a win on the board is important, as we know from Doug Song and others. Make sure that your first deal goes well, even if that means you sacrifice some economics in making that happen. Very important going into your second deal that you're 1 for 1. And so they locked that in, and you can see how that might be valuable.
If I was to guess, a lot of sponsors err on the side of exiting too late. And so here you have the potential problem of exiting too early. So I think it was a quite unique situation for us and for our podcast to dig into that question, because I think on balance, sponsors probably err on the other side of the spectrum, which is probably not better, right? If you're sitting on an asset too long, the IRR creeps down, you lose momentum, you lose optionality because your debt starts to mature, your investors are fatigued, and also you've just spent a lot of time, you sink a lot of years into these projects, versus here, in and out in 2 years, make some money, get a win on the board, build a track record, and here he can move ahead to his next platform already. That is, he's still working in the company, he's focused on the earnout, he's very clear that he's fully focused on that until he potentially is no longer employed there in the future. But nonetheless, he's cleaned the pathway for himself now to move ahead to the next project, and maybe that is better than sitting on an asset too long, right?
Well, I think you have some exposure with this asset as well to the macro situation, some pretty serious exposure. And there's been a lot of macro uncertainty over the last few years. I think we're kind of running through patterns of everything's fine to every once in a while, we're headed towards a recession, interest rates are still too high. So I think this is, a lot of these rentals are kind of luxury rentals in ski towns, which is obviously a very expensive hobby. It requires a lot of disposable income. So, I think he mentioned that to some extent on the podcast, that was a concern. But it certainly would be in the back of anyone's mind holding this asset. I'm not sure it's the asset that you'd want to be holding if we're hit by a major recession. So again, like you said, Nicholas, it's kind of a bird in the hand situation. He got a win. In hindsight, it looks like maybe he could have held it longer, but I think it's a little tough, potentially in this industry, to know exactly the right time to sell.
Well, I have the impression, haven't done my own analysis, but have the impression that this is a quite small industry. There's only so many tourist destinations that have a big enough ecosystem where you can have property management, vacation rental property management businesses of any size or scale. And he says that at $5 million of earnings, his was quite large for the industry. And then they go out trying to acquire others. They do successfully do that twice, but then they lose out on other deals. So if your path to growth is inorganic, and while there might be fragmentation, it's fundamentally a pretty small industry, and somebody's outspending you, it starts to feel like growth, even though the industry is kind of doing well, it still feels like a pretty small one, and there might be not a lot of obvious ways to grow. And frankly, what they did was, when the market got too hot to buy, they became sellers. Well, Sarkaw, again, we thank you for letting us unpack your deal there. Really a good sport, a great learning for us and for people who sit for the interview, who've listened to the interview. So thank you, Sarkaw. Before we get to the interview, let's hear about some more data from our strategic partners, GF Data, that is giving a sneak peek into their quarterly reports. Max, I think you have more to add from last time.
Yeah, just a little bit. And as a reminder, so GF Data, one of our sponsors, is a platform that aggregates data from private equity funds, family offices, independent sponsors, SBICs, and mezzanine funds. They have 334 active contributors to their data set. So they're a great source of data for valuations and trends in the lower middle market, which is where we all play. So another bit of information from their Q2 report, which I found to be interesting. This is dealing with platform acquisitions versus bolt-on acquisitions. Bolt-on acquisitions in the first 2 quarters accounted for 39% of all the buyout transactions that were submitted to GF Data, as opposed to platform acquisitions. And that's not inconsistent with everything that we've all heard in the marketplace. There are kind of fewer platforms out there. They're harder to find, and interest rates are high. So there's been a lot of smaller acquisitions in the last few years. But what is interesting is there's typically been a 1 to 2 turn premium on platforms, and that sort of disappeared this year in the first 2 quarters. So both platforms and bolt-ons are sort of trading at about 7.6x EBITDA to 7.7 times EBITDA, and that's a really tight band right now. So there's usually a premium for platforms because it's coming with a brand and a management team and all the infrastructure. I think it kind of alludes to the fact that the bolt-on space has gotten a little more competitive right now. There's more folks looking for those deals to add EBITDA to their existing platform. So an interesting data point. So that valuation band has gotten a lot tighter, and bolt-ons continue to be a very significant count within the buyout space. Another interesting data point, and this is a longer term data point, the GF Data goes back to 2003. And so every deal that's been submitted over that time period is in their database. When you look at the aggregate of the data from 2003 to Q2 2025, 2/3 of all of the deals that have been submitted by the contributors are in the $10 to $50 million enterprise value size range. And so, that's a huge amount of deals in terms of all of the deals that are being submitted. Most of them are in that size range, that $10 to $50 million size range. And that's exactly where independent sponsors play. If you think about the McGuire-Woods survey from 2024, it noted that most of the deals are in the $10 to $100 million size range, $10 to $70 million size range. This is broken up in GF Data just a bit differently because of the next bucket is 50 to 100 million. But a huge amount of deals within this bucket, tons of opportunities for independent sponsors. And I think that's part of the reason, obviously, why independent sponsorship has grown so much. That's where all the volume is in the M&A space. It's right in the strike zone for the independent sponsors. So interesting data. We'll continue to give more data from GF Data as we get it quarterly. It's been interesting for us, and I think it's a great place to get a pulse on the market, on especially the lower middle market.
Yeah, fantastic. Let me chime in actually a little bit, because we had an intern with Minds Capital this summer, and one of his primary jobs was to scrape our own database from the last year or so with hundreds of deals to see if he could see any trends or patterns in the data as we collect them deal by deal on an aggregate level. And I think the biggest takeaway or biggest surprise for me personally was the lack of surprises, honestly. I think the industries you expected to be more expensive were more expensive, right? So you definitely saw that pattern hold true with SaaS, MSPs, high growth healthcare, trading 6, 7, 8 times or much higher with SaaS in particular. And then energy and infrastructure would be much lower, more in the 4x range perhaps. And then the other industries would be somewhere in between. But overall, a fairly tight range on valuation from our entire data set. And then the other thing is we looked at the terms, the investor terms from the various sponsors. And I think it has emerged that the standard set of terms is there are three kind of pillars to it, right? You get a closing fee that is 1% to 2% of enterprise value. You get a management fee that is 5% of EBITDA, typically with a floor of, call it $200K, give or take, per year. And then you get carry, which the very standard one would be 20% over 8% hurdle, but not uncommonly you see some kind of kicker for upside cases as well. And this matches the data of what we have invested in. And overall, you just don't see a ton of deviation from this. So it seems like the industry overall, everyone is reading the same data reports from McGuire Woods and they're really converging around these terms. It's controversial, I guess, if you stray too far away from it. So I think that's probably quite different from how it would have been 10 years ago, that there is much more standardization now as the market has matured.
That closing fee, Nicholas, what is our position on it being put into the deal?
Right. I think it's frowned upon when a sponsor cashes the closing fee, because shouldn't they have sufficient conviction to roll it into the deal? It's never been cash in their pocket, so why should they take it out? It's quite common and understandable if they reimburse themselves for expenses related to the deal, but the closing fee itself, almost always you see it rolled, even for first-time sponsors. And real skin in the game comes when they put their own cash into the deal. So on top of that, it's incremental. And the more of that, the better, of course, because it creates alignment with us as an investor.
So just to do some quick hypothetical napkin math, for a first-time sponsor, they'll spend a couple years searching. They'll spend 6 figures on getting the deal done. So now they're out of pocket 2 years opportunity cost of lost salary, plus low 6 figures, but substantial but lowish 6 figures for the deal costs. Then the closing fee, maybe they'll reimburse themselves some of that, but oftentimes we'll see that all of it just goes right back in. Then they'll get their 5% of EBITDA with maybe a floor of 200 or 250. But of course, depending on what EBITDA is, that looks like, call it 250 to 700 after 3 or 4 years of being at this. So this is, as we often say, very difficult for first-time sponsors to do a deal, get in the game, and make it a viable enterprise. But for any sponsor, it's going to take some number of years for this to become really financially remunerative.
Right. My friends in Dallas, Grant Cornman and Edward Crawford, always calls it the get-rich-slow scheme. And we had a pre-call the other day, Will, with a sponsor who said it takes 2 years to get any income at all and 4 years to break even, give or take. And upside happens quite a bit after that again. And so, yeah, it's not instant like investing in Carvana or NVIDIA in 2023. It can take time.
And was that your experience, Nicholas, with your platform?
Yes.
Yeah, I think you have to be willing to play the long game here, and you have to believe in yourself. You have to believe in the investment. I think it's totally reasonable for that first-time sponsor to reimburse themselves for the fees and for even maybe a little bit of salary that was foregone during a kind of a search period. But I think at least probably half that fee needs to get rolled in. There has to be conviction. Otherwise, what better investment should be out there than your own independent sponsor deal? I think there shouldn't be a better investment out there.
Right. And they don't pay the fees, right? Because they don't pay care to themselves. Yes, I've had the same experience. It takes time. But that said, the dynamics change dramatically once you close the first deal, because you go from burning cash and having uncertainty to having a close deal behind you. And now you at least have enough money to cover your mortgage. And for a lot of searchers and sponsors out there, the search itself can be done at a very low budget. It's really when you get into an LOI situation and you start having vendors and legal in particular, that costs start to accrue. But what I mean by that is both for your first deal, but also if you're gunning for your second deal, you have enough to cover your mortgage and you can kind of scrape by and you take a swing at the legal fees. And hopefully if you can then close your second deal, now you're starting to see real surplus cash. You have a pretty decent overall salary. You're almost in most cases in a position where you can think about hiring an associate. Of course, the dynamics change if you have 2 partners or 3 partners, but for a solo sponsor, you're in the game if you have 1 deal, because then you're more than break even, and everything on top of that is icing on the cake, right? So,
further evidence of why exiting after 2 years and getting some money in your back pocket could really make sense for people early in their career.
Nice way to circle it all the way back, yes.
Absolutely.
Well, without further ado to Sarkaw's interview, let us get to it. Quick thank you to GF Data for the partnership, for sharing their data with us. We look forward to getting more sneak peeks. And my typical reminder to all listeners, if you're a sponsor with a deal under LOI, we are investing in such deals, so please send it over to us, deals@mindscapital.co. And if you are interested in investing in this asset class, we are preparing our own second fund here pretty in the fall. So head over to mindscapital.co and you'll find a link where you can fill out a form, get yourself qualified as an accredited investor, and learn more about when we kick off that raise. Please enjoy episode 29 with Sarkaw Aziz on the Minds Capital podcast. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Based in Denver, Sarkaw Aziz exited his vacation rental property management company to a strategic buyer this summer. Today, we will learn about Sarkaw's journey through corporate to HBS, where he became a searcher, and how he and his partner entered and exited this fast-growing, consolidating market in a 2-year time frame. Sarkaw, welcome to the Minds Capital podcast.
Thank you. It's a pleasure to be here.
So let's turn our attention first to that 2-year time frame. Talk to us about how you decide, after only 2 years, to exit a platform.
Yeah, certainly. Well, it's interesting the way that things started because it felt like when we first were introduced to the industry and started looking at deals, both brokered and proprietary, everything still felt very nascent. And while I would argue that it's still very much so a nascent industry, it seems like just in the 2 years since our initial acquisition in the space, things have really heated up. And there's quite a bit of institutional capital now that didn't seem to exist just several years prior. And so for us, it was a bit opportunistic more than anything. We were actually exploring a potential recapitalization of the business, and in having some of those discussions with folks who were close to the industry, brokers who were close to the industry, we were introduced to a couple of the buyer groups in the space, and things kind of just happened organically. And once we looked at the numbers and crunched the numbers and looked at the economics, it felt like a good time to exit, even though it was a lot quicker than what we underwrote initially.
And was the idea not only, opportunistic, as you said, the timing ends up being right, but you could also argue that continuing in a space that's just heating up, that you still have some runway for it to continue to heat up, for you guys continue to grow the business and exit at a higher valuation while the industry itself is heated up another couple of years later. I suspect there was just kind of a getting a win on the board strategy as well here.
I think that definitely played into it. I would also say that our group of investors also agreed that it was an attractive offer and an attractive time. And specifically leading up to our own exit, we placed a couple of offers on larger bolt-on acquisitions that would have served as good beachhead acquisitions into new markets as we were thinking about expanding our footprint nationally. And we lost both of those deals. And so one of the things that I think we realized is that we were more competitive on the smaller bolt-ons, and in larger acquisitions and more beachhead type acquisitions, we seemed to be less competitive. And after we sold our business, we realized that the two large businesses that we went after, that we got outbid on, we were outbid on by the same group that bought us. So I think that kind of brought us full circle and gave us some vindication around the timing of things.
And give us a little bit more on the industry. So vacation rental property management, what did your company look like, and why has it become hot? For those who don't know, just kind of give us the 30,000 foot on the industry.
Sure. I mean, I would say things have probably heated up for the same reasons that attracted me and my partner to this space, which is that the business fundamentals are good. It's recurring contractual revenue, asset light, high margin business. There's a lot to love. And even though switching costs, in theory, switching costs are not that high, there is still some stickiness to those customer contracts because the bookings are rolling in oftentimes months in advance of the actual stays. And so as owners start to see revenue on the books for the upcoming ski season or upcoming summer, if you're in a beach market, then they kind of tend to stick around. And so that creates a little bit of stickiness as well. And there's varying degrees of flavor on how people choose to run their businesses in this industry. We were, for the most part, vertically integrated. By that, I mean, we did everything in-house, from sales, marketing, to housekeeping, laundry, maintenance, all of the services that go into providing a good stay for guests. We were handling, for the most part, in-house, with few exceptions. And there are other companies that choose to contract out a lot of these services, which makes the asset light model even more so. But then that also comes, I think, sometimes at the risk of reliability and perhaps maybe some suppressed margins if your housekeeping team, for example, if your housekeeping department is no longer a profit center, as it was for us.
Yeah. And where was your business, and where was the inventory, and what did the typical housing unit or vacation property look like?
Yeah, so we were in 3 different markets in Colorado. Keystone, Breckenridge Resorts, Winter Park Resort, and down in Telluride. All ski markets, but the one nice thing about these mountain destinations is that you get a nice secondary bump also in the summer, and then the spring and fall are largely just your shoulder seasons and kind of time to strategize and clean house, so to speak. As far as portfolio goes, I would say it was a diverse mix, anything from 1-bedroom condos all the way up to 9+ bedroom homes. The bulk of our inventory specifically, 2 to 4 bedroom condos and homes.
And where does Airbnb fit in with this business model?
Sure. Airbnb, Vrbo, Booking.com, all of those companies serve as channel partners for us. So when we take a property and we manage it on behalf of our client, we market that property on our own direct website, but we also market it on Airbnb, on Vrbo, Booking.com, and any other marketplace type platform.
And what percentage of your rentals come via the platforms where you're having to share a lot of margin versus direct to your website?
There's a high degree of variance on that, actually, depending on where you operate. So a lot of the beach markets, for whatever reason, tend to have a much higher percentage of direct bookings. We've looked at companies in the Outer Banks of North Carolina that have had close to 90 or over 90% plus direct bookings, where it's essentially, the same family that rents the same house in the same week of June, year after year after year. And they make those bookings oftentimes a year in advance. In the ski markets and many other markets, the percent of direct bookings is generally a lot lower. And specifically for us, we were hovering around 25% direct bookings, the rest of which came from our channel partners.
It would seem that when assessing businesses to buy, the percentage of direct versus channel would be a huge question, a huge variable in the value of the business.
To a pretty good extent. I mean, I would say, of course, direct is always more coveted because the margins are a little bit better. It's actually a bit of a win-win because we, as the hosts, the property management company, make more money that way, and the guests actually also end up paying less. But generally, the standard in the industry is hosts pass on the cost of the fees that the channel partners tack onto the guests. But I think it's just, I don't know if it's peace of mind or convenience or just force the habit. A lot of guests still tend to go directly to the Airbnbs and Verbos, and they don't think to go to the direct host. And sometimes it's not really an option. So if a house is managed by the homeowner, chances are they're only on these channels. They likely don't have their own website for their one house that they're managing. Or even if they do, it's maybe a little bit harder to find. But anytime that those properties are managed by a property management company like ours, when you scroll down to the bottom, you see the host is a company. You can actually go to that company's website and generally get a better deal for the same place. A little bit of industry insider
I've done
knowledge.
exactly that, actually. Yeah.
Yeah.
Let me take you back a little bit to the strategic decision point you had here earlier this year, since you exited after only 2 years. Can you share a little bit about where you started with this platform? What did you buy it at, and how did you evolve it between organic growth and M&A to get it to where you had it when you sold now?
Yes, certainly. So my partner and I initially looked at a broker deal in this space that we got outbid on by actually friends and acquaintances of ours. And but as we looked at that deal, there was a lot about the industry that we liked. And so we started doing our own proprietary outreach. And the idea was always to buy something that had adequate infrastructure, that could be a great beachhead acquisition, and then try to grow locally and regionally from there, while also keeping open the option of acquiring other beachhead acquisitions in other more disparate markets. And so our first deal, and actually also our first bolt-on, were both through proprietary deal sourcing channel. And our first deal was definitely on the larger side with proper infrastructure, strong middle management, and almost 6 months to the date after that initial acquisition, we had our first bolt-on acquisition in an adjacent market. And although much smaller in size, still had sufficient infrastructure to operate autonomously on its own. And then 6 months after that, we had our second bolt-on via a broker deal. Of course, the whole time we invested in sales and marketing and tried very hard to grow the business organically, and we were doing that. But a lot of the growth, perhaps just given the 6 months cadence of the 2 bolt-ons, were driven by acquisition rather than organic.
And so how big were these entities that you bought, the first one and the bolt-ons?
The first acquisition was a little under 5 million SDE.
Oh, wow.
The first bolt-on was a little bit under 500,000 SDE, and the second bolt-on was around 800,000 SDE.
My limited knowledge in property management tells me that the first one in particular is a very sizable company here. And is that what you saw as well, that it was compelling because it was built out and had critical scale?
Yeah, absolutely. It's a pretty highly fragmented industry. And so any company in this industry that's doing multiple millions of dollars in EBITDA or SDE is considered pretty sizable. And I would say specifically for the mountain markets that we were in, it's you see a lot bigger players in some of the beach markets in the Southeast. But even then, a $4 or $5 million EBITDA or SDE company would be considered a sizable company. But it's a little bit more common there, whereas in the mountain regions, that's among the top.
And do you value it based on the EBITDA there, the SDE or EBITDA, or do you value it based on revenue or even number of doors? I've heard conflicting things within property management.
Sure, I think it depends on the situation, really. I think for us, first-time entrants into the market, we really looked at it as a valuation. We looked at the valuation as a multiple of EBITDA. But as you're thinking about a tuck-in acquisition in that market, if it's on the smaller side, you can think about it as a multiple of revenue, or frankly, you can just look at the contracts and know how much that should generate and pay based on the synergies with your existing business. Because once you're strategic, you kind of look at things from a slightly different lens.
Right. Okay. So the platform that you did, which you found proprietarily, isn't it also so that the seller stayed on board? Did he roll any equity?
The seller actually rolled significant equity because he specifically did not want a big payday initially. And so he ended up rolling 50% equity and providing a seller note for the debt piece.
Tell us more about his psychology. What seller doesn't want a big payday? And where can I find one?
It's an interesting question. I think probably a question he's better suited to answer. But we discussed this a little bit. I think it was largely just driven by the fact that he was not really anywhere close to retirement age, and he just didn't want a huge tax bill and was looking for a bigger second bite of the apple, which in hindsight, after the exit, he was justified in the way he approached things. Of course, he still got the payday once we exited, but his rolled equity ended up with some pretty significant returns.
But you talk about the seller note as a very conventional structure where 10% of the deal was a seller note sitting behind the senior debt, but that was not the case here, right?
No, the seller note was the only debt on the business. There is no senior note or institutional debt.
How many terms of EBITDA was the initial seller note, would you say?
About 3.
Okay, well, so here you really have a largely seller finance deal between 3x EBITDA on a seller note and 50% roll on the equity. So you're then left with, okay, we're going to, in this case, come in and be very active, we're going to find investors who can help us for the rest of the 50%, but who can also inject capital to do some add-on acquisitions. Is that how the conversation played out?
Yeah, precisely.
How do you even start a conversation asking for a 3x seller note?
Well, it's funny because we went through several iterations of the deal. Again, I think the unconventional structure was largely driven by the seller's desire, at least initially, to keep a lot of skin in the game and go for a second bigger bite of the apple while minimizing tax obligation. Yeah, I wouldn't really expect that in really any subsequent deal. And even in our two smaller bolt-ons, we had seller notes for both of those, and it was just standard 15-ish% of total enterprise value, mostly just to align interests in the transitionary period. Nothing more.
Does the seller note, the big seller note in particular, help alleviate the tax burden?
Well, I think, I mean, I'm no CPA, but I would assume so. I mean, if that did not come in the form of a seller note, if it came in the form of institutional debt, then that would be that would go towards cash on closing for the seller, for which they would have to pay a pretty big tax bill on.
Massive skin in the game from the seller in this case. So a very strong alignment. Okay, so what happened then and you exited, right? Can you share a little bit about the return profile that you generated for your investors exiting after 2 years?
Yeah, we ended up, or investors rather, ended up with 2x MOIC, a little bit over 2x MOIC net of fees, and 41% IRR.
Right. Okay. So the IRR, IRR in the 40s is considered extremely high, but this happens in this case a little bit by virtue of the very short hold period, right?
Correct. So that's why I think really the 2x MOIC is really the number to hone in on, because that's essentially irrespective of the holding period. But doubling investor money in 2 years, I would say they were all pretty happy about that.
But strategically, if you've been able to double it through M&A, stable business, recurring revenue, why wouldn't they see a pathway to they're holding a pretty safe asset here, right? And so isn't there a pathway to get up to 3-4x MOIC if they hold it for another 2, 3, 4 years?
Yes, we could have. I think it was driven by several factors, one of which was what I mentioned earlier, in that we went after a couple of bigger deals. We lost out on both of them. So I think we felt maybe multiples were perhaps tad bit inflated, or something about our offers in general seemed to not be as competitive anymore. And so, we could have chalked that up to coincidence and stayed the course and kept going after bigger deals, and perhaps we would have landed one or two. I imagine at some point we would have, especially if we would have said, okay, we lost this one because of reasons A, B, C, so let's go be more aggressive in these regards, and perhaps we would have ended up with something, winner's curse or not. Then at that point, you couldn't really say. And so I think, that was part of it. And then the other part really is just that, yes, we could have held it and strong cash flowing business. We could have paid down debt. Perhaps we could have made some distributions. We could have made some progress towards MOIC. But then also, at that point, there's unknown execution risk in the future. You're staying exposed to regulatory risk, other macro risks, economic downturns. You just think about your gambit of macroeconomic
right.
risks that you would then be exposed to.
Was this offer that you got from a strategic, a proprietary offer, or was it a brokered process when you exited?
Well, perhaps a little bit of both. We, like I said, we were in the process of recapitalizing the business. So this is what we were trying to do. And so we got with a broker in the industry who...
Why would you recap the business when you have such a nice seller note structure?
Well, I think because actually one of the reasons was, that the original sellers of the initial business wanted to take some chips off the table,
okay,
and perhaps use some of that money for future bolt-ons. And we felt that if we were really, really going to scale, that we needed an institutional debt partner.
Right.
That was the basis for trying to do that. And then in that process, we knew of a couple of groups, institutional players, who were starting to make acquisitions in the space. And then the broker introduced us to another player in the industry who does a lot of acquisitions every year. And that is the group that we ultimately ended up selling the business to.
Okay, interesting. So yeah, I'm trying to get into the boardroom conversation here, I guess, because it is quite unique to exit so quickly. But it seems like you guys were trying to improve the balance sheet, in particular to appease or facilitate for one of your biggest shareholder, the original founder. And then as part of that conversation, this opportunity to sell to a strategic came up. And then were there any voices in the room that were against selling? And if so, what were their strongest arguments here?
Actually, no, it was pretty unanimous. Yeah.
Because if I think about a lot of these lower middle market deals, not a lot perhaps, but every now and then you'll see them bought well, right? So you buy a deal for 4x that should be 5, maybe 5.5x. In theory, at least, your equity returns, if you've levered it up 3x like you did, should be 2x right out of the gate on deals like that. I'm not saying they happen every day, but they happen every now and then. That's one of the asymmetries that people like in the lower middle market. But they don't rush to the exit, right? I mean, there must, a sponsor has a value creation plan. They have a Gantt chart, if you want, of initiatives that they want to complete. So I'm just wondering, you guys suspended that midway through, presumably, in favor of a very strong return, no doubt. But when your investors bought into this, I would imagine they were hoping for more than 2x, even though it would have taken longer. So on an IRR basis, the returns there are incredible. But when they signed up, most of the investment memos we look at are 3, 4, 5x MOIC, right? When the base case projections. So that's what the investors hope for when they sign in. So is it that they came in and lost a little bit faith in the organic growth of the industry, lost a little bit faith in your ability to compete M&A? Or yeah, I'm just trying to really get the color there, I guess.
No, actually, I don't think that was the case at all. And of course, 3, 4, 5x MOIC was everybody's expectations going into it, but that was also with a 5, 6, 7 year holding period.
Exactly. Yeah.
So to be at 2x,
Yep.
2 years to the date was really just an attractive opportunity for everyone. And as far as I think the way that we were structured, at least, because there was not a committed fund beforehand, it was more on a deal by deal basis. And so for every bolt-on, we were taking that to the board, having this boardroom conversation, as you said. And so, whatever deals were lost or that we couldn't get under LOI, it was a board majority decision issue. And so I guess that failure, to the extent that it's a failure, is kind of a collective failure, not so much just on the managers.
It will be the first time I think anyone has heard about 41% IRR as a failure, but that's not the direction I was going at all. I'm just curious about it. Because also, isn't there, and my knowledge on this isn't very crisp, but isn't there like a 3-year time limit, at least for carried interest, in order to qualify it as long-term capital gains as opposed to regular income tax? Were you hit by that?
This really gets into the weeds of tax advisory. My understanding of it is too layman's for me to try to sell anybody on it, but we did consult tax advisors with our counsel prior to exit, and their interpretation is that the carried interest, because this was our primary thing and essentially our full-time jobs, our interpretation of it is that it does get treated as long-term cap gains versus like being a bona fide PE fund manager where it's just a run-of-the-mill carried interest where you do have to have a 3-year holding period. Ours is considered distinct from that.
Thank you for that, by the way. I think my knowledge, just to put it out there around this, because I came across it a few years with a platform, is if you have carried interest as a sponsor, which we all do, while it goes from being regular income tax, so call it 39-40% federal income tax rate, to long-term capital gains tax rate. So that's 23.8% federally at the 3-year mark of an investment. And so that matters. And if you get a strategic buyer in the door in year 2 or year 2.5, you might want to slow walk things a little bit to get across there, especially if you're standing to make substantial gains like you were doing here.
I think something that it ended up being a moot point based on advice from our tax advisors. Yeah.
Right.
But otherwise, definitely something to consider.
It's interesting you bring up, it seems like the lack of institutional capital, which is a very attractive and compelling part of this story when you first present, we were able to buy this really large business without really raising institutional capital. But in a fragmented, fast-moving, consolidating space like this, the lack of institutional capital became a disadvantage that it enabled this incredible entry, but it also forced your hand a little bit on the exit. Is that right?
Sort of. I think if this strategy would have been to continue acquiring smaller companies as bolt-ons and tuck-ins, a lot of those, I mean, our first bolt-on was a little over $2 million enterprise value. We just bought that with balance sheet cash. And so those types of businesses, and we probably could have bought like 2 of those a year, just essentially with balance sheet cash and a small seller note. Maybe a little bit of rolled equity if that's something we would have found attractive. But when you're thinking about beachhead acquisitions in other markets, where we're saying, okay, how about Utah? How about Montana? How about a beach market in the Pacific Northwest or somewhere in the Southeast in Florida, Gulf Coast? When you're thinking about those other beachhead type acquisitions, and now you're looking at a $20 million enterprise value, $25 million enterprise value, you start to need institutional capital, at least for debt. I think between our investor group and our very strong balance sheet, we would have had the equity piece covered. But if you need to have $8, $9, $10 million of debt in order to make an acquisition, then you're going to need some institutional capital. Because again, a lot of sellers, like you guys mentioned earlier, they want that big payday and they want to be out, right? There's not a lot of sellers who are willing to do 40% seller note.
Sarkaw, one thing that we or that you had mentioned on the pre-call was the kind of the complicated nature of the waterfall in your structure with how it vested and the tranches and so on. Can you say more about that and why, as you reflect back on it, maybe it was more trouble than it was worth?
Yeah, I think where that got complicated is my partner and I started on like the search fund path, and we thought of ourselves initially as searchers, and then that kind of morphed into something with like the world of independent sponsors. So like, you know, in the independent sponsor world, like 2 and 20 is very standard economics. In the world of search, you know, you've got self-funded search economics, you've got traditional search economics. We actually started out as, we were self-funded searchers, but then the size of the equity check that we needed put us in traditional search fund economics. And then at one point we were talking to a couple of SBIC funds, and they were more familiar with the world of independent sponsor economics. So we were trying to triangulate all these things to see what makes sense. And we kind of ended up with this like hybrid traditional search / independent sponsor economics, which I think ended up being a lot more headache than it was worth. I think really just going in there with a 2 and 20 or slight variance from that would have probably been the most straightforward thing to do.
Did the timeline affect the complexity of the structure that you had? Meaning, would it have been cleaner or easier or less complex if the investment horizon of 5 years had materialized as initially planned?
Well, so our first tranche was preferred pref equity hurdle. The next 3 tranches were all MOIC based, so presumably the timeline would have had a big effect, yeah, because we could have paid down more of the equity and worked towards those MOIC tranches, yeah.
Yeah, that's interesting. So IRR goals typically favor fast exits. MOIC incentivizes long hold periods because it takes time to multiply your money many times over. And
that's right.
In this case, you didn't really benefit from the high IRR in the same way if you had.
That's correct. Although from what I recall from traditional search economics, I think, you know, one of your tranches is a 4-year holding period. So if you end up with a really high IRR very early on, you still don't vest in the same way as if you held it for 4+ years and hit that IRR hurdle. So I think they still get you somehow. But I will say our initial thesis was exactly that we would hold for a lot longer than 2 years. Really, a lot of our models, I think, were done maybe on an exit in year 6. But we were open, conceptually at least, to the idea of holding this for the long term. I mean, 10+ years. We were open to that. The exit really just ended up being something that fell into our laps at the time that it did.
Sarkaw, you said that you guys started out as searchers. You identified as searchers, and that implies a lot of things, among them being in the business, operating the business.
Yeah.
And so now, looking forward, you know, understanding that the earnout is where your focus is now, but whenever you're looking at your next entrepreneurial project, do you think it'll be the sponsor model where you're not necessarily operating? Or do you think it will be independent sponsor model independent sponsor economics, but operators in, say, a single business, or some sort of, again, searcher style approach?
I personally am drawn to operating. So I think I would never close that off. But I think ideally to be in a true independent sponsor role feels attractive from where I sit today. But it's just so deal dependent, and understanding the cap structure and how much equity you're able to raise, to see does it make sense to bring in an industry exec, install that person as CEO, and then you're truly in an independent sponsor position where your focus is more on roll up, deploying capital, stakeholder management, other higher level financial management. That sounds really attractive, but I think for me, that depends on the investment thesis / specific target and how much money we could realistically bring to the table. So specifically, I mean, if the equity raise, the fundraising is somewhat limited, then I think it makes more sense to, again, end up in a more ETA style acquisition where we would essentially be the C-suite.
Sarkaw, to the searchers listening, not the independent sponsors, but the searchers, what would you tell them about the independent sponsor model that would help them differentiate between the two and maybe even decide between the two? A lot of searchers don't really are exposed to independent sponsorship, if at all, much later. And yet, in your case, you ended up essentially, you were kind of a hybrid, as you said, but essentially kind of being sponsors as your first time. So what would you tell the searcher audience about independent sponsorship?
I think if nothing else, it expands your pool of investors. It's something that's been around for a long time. People are familiar with it, and it translates well into the world of, whether you end up doing the debt and a minority equity investment with an SBIC, or even if you're thinking about partnering with a family office or a lower middle market PE fund, the 2 and 20 model is something that people easily understand and can conceptualize. And it's just a lot easier than the tranches of a traditional search where you've got, a third vest at close, third vest after 4 years, assuming you're still around. The other third, as I understand, invests linearly based on IRR hurdle. And that just sounds like a complicated waterfall, which it can be done. And it's being done all the time in the world of traditional search. But the 2 and 20 is just easy, straightforward, and people understand it. And so that way, if let's say you start out with traditional search economics, but as you continue to grow, you're looking at different group of investors, and perhaps you end up with 2 different waterfalls, but then that even just further complicates the structure. Whereas I feel like typical search fund investors can very easily conceptualize and get behind the 2 and 20 model, like other types of investors. And so you can really end up leading with that. And especially if your acquisition is on the larger side, or you have a very large planned roll up, then 2 and 20 just makes a lot of sense.
Yeah.
Accelerates past brain damage of complicated waterfalls.
Great. Thank you. We got to let you go. Sarkaw Aziz, was there anything else that you wanted to share that we didn't get to?
No, just that I appreciate your guys reaching out, and I appreciate the time, and hoping that my experience is somewhat useful to other searchers and independent sponsors out there, and some of the complexities to avoid. But enjoyed being on here and appreciate your guys' time.
Well, thank you for letting us press you on your deal. Obviously, it was a great one. Congratulations for such a strong return in such a short amount of time. That is a really strong first deal out of the gate. So congratulations to you on it. And thanks for joining us on the Mind Capital Podcast.
Thanks, guys. Take care.
Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.